were going through one of these sovereign debt crises, we're now increasingly getting the consequences of that system because the system is not inherently stable. It's only been metastable in the sense that it's been able to keep the wheels on the cart for 5 decades and counting. But some of those issues are building up more and more. The way fiat currencies get introduced is basically by initially trying to solve a problem, which is gold's portability, authentication, and other challenges. And then over time, people get rug pulled. Basically what it is, it's an accounting prison and a savings prison. And so small amounts of problems build up and get papered over from recession to recession to recession. But the problem is they don't go back to their prior baseline each time. That'd be a stable system. But then that last part of the cycle, it's kind of like the problem keeps getting kicked upstairs. You start in the private sector, it goes into the real estate sector, it goes into the banking sector, and eventually a lot of that excess gets just put into the sovereign level. The years or decades ahead, as these big countries work through their untenable debt loads, and they no longer have that declining interest rate to offset them, either sharply devalue their monies, damage their own monetary network effects. When systems get to that point, they start getting on track for a reset, or perhaps a less loaded word is recapitalization.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with sound money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold worth €60 or $50. Just click on the link in the description. Welcome to the show, Lyn. It's been some time. Pleasure to have you.
Happy to be back. Thanks for having me again.
It's great. I have to say a lot of things happened since we spoke. I think last was almost 2.5 years ago. And since then, obviously, things happened in market, but also things happened on your side. You just released a new book. It's your first book. It's called Broken Money. It's been one of the most sold books and banking and finance economics on Amazon, and it's been also for a reason, and that's one of the things that I want to also talk about today. I as you can see, have it right there next to me, and on that note as well, with something that's very symbolic. I guess you can kind of recognize it. It's
that's awesome.
It's it's a good, I think it's the best bookmark you could have for that book, literally. Perhaps you should actually have it with the book when you sell it.
I did a book signing in LA like a month ago, and we ran out of books. And so for the people that were still in line, we were not able to keep selling books. And so instead, we had a pile of Venezuelan bolivars, hyperinflated ones. So I sold those. I signed some of those as bookmarks for people to at least, they don't leave totally empty-handed.
Mm-hmm. I guess the signature had more face value than the actual worth of the.
It adds a little scarcity, I guess.
Of the bill, exactly. You turn those notes into gold. This is actually the only moment I can say I'm a billionaire, because this is literally $10 billion, and it's from the Reserve Bank of Zimbabwe. We all know what happened there. And I think it's also a good, casually just putting in there. A good intro into the segue of what money is. I know that you've covered it over and over, and many podcasts ask you the same question. So I'm not gonna ask you like that question like in this regard. My first question, and I will always start with this one because it's more of a tradition, is what is your most heretical view about the financial system?
I mean, probably the basic one, which is that I don't think state should issue money, or at least I don't think it's good that states should issue money, um, in the sense that I would like to build to a world where technology allows that to no longer be how it's done. The way I would describe it is that since the dawn of the telegraph era, when people needed faster money, it was kind of a natural consequence that it would kind of coalesce, and then governments would just take it away from banks, basically. It had a natural centralizing force to it. And so I would like to see technology allow for some of the incentives to change so that that is no longer the case. I think Hayek described it best, which is, through some sly roundabout means introducing a new money that they can't stop. So I think that it's in circles that I'm in, that's not a very heretical belief, but in terms of mainstream economics, the idea that money doesn't have to be connected to the state, and ideally shouldn't be connected to the state, is something that is very low acceptance.
Yes, because I think in most cases, you could say that money has more components to it than the features we see it today, right? I think the question is the money that we use today actually money? And I think that's the first question I would like to ask you.
So I know some people like to they call it currency instead of money. I think for me the it's a little bit semantic, which is why I don't jump into it. I mean, I would say it solves the what money's meant to do, which is basically avoid the double quintessence of wants and be a trading unit. When you go to a different country and you see a gray market or a black market, and they're actually doing dollars, and this is it's not forced on them, and if anything, it's almost like they're going to get drugs, kind of like it's a little bit shady because it's something that the brokers can get arrested for in some places, but it's like they're getting their hands on dollars, and so that's an emergent bottom up decision to seek out dollars as money in those countries. And so I would say that currencies are a type of money. They're obviously an issued money. They're not a commodity money. So I would say that I don't really make that distinction that some do between currency and money, even though there are some differences there. I would say that currencies get monetized basically, even when they're not fully imposed, if they're the best ones, or at least if there's not something better out there that people understand. And watching that happen in other countries is I think an interesting kind of thing to see, because it's not something we think of people clamoring for another currency from another country.
Mm-hmm. In that regard, because that also like in a way the traditional definition of money would be a current medium of exchange in the form of coins and banknotes. That's the way we know it today. But I mean, lots of figures or more, let's say, fundamentalists, just like Aristotle is defining the different properties of money, have since already thousands of years been able to define what money was. And one of the things that I find very interesting is that money is quite anachronic in a way that money today was not necessarily what money was thousands of years ago. It went from all the way being commodities, tobacco, seashells, all the things that you talk about in your book, to gold, and to now what a lot of people would say Bitcoin, for example, digital currencies, which is purely digital. It's not even in this realm, actually. So it really depends of which era we're looking at. And one of the things that I would like maybe to know is what would be your addition to the definition of money, of what's already being out there. And before I let you answer that question, I would like to read out a definition of money that struck me, that when I went through that journey of money, actually a lot of things that you wrote in your book, I had the same journey 2 years ago when I really went into that rabbit hole. And I literally did months and months of reading papers, books, and so on and so forth. And I stumbled on one from, maybe you know him, Marcel Mauss, who wrote the book The Gift. He's a French anthropologist who did a lot of work in Polynesia. And he defined money as follows in 1969. Uh, and defined it as money is by no means a material and physical fact. It is essentially a social fact, and its value is that of its purchasing power and the extent of the confidence we have in it. And this is the origin of an idea, an institution, a faith about which we speak. What do you think of that?
Yeah, I think that's a reasonable definition. And I think that there's a lot of definitions that don't necessarily conflict. I mean, some definitions do and some don't. I've always been partial to the medium of exchange, store of value, and unit of account. I feel like that's kind of a practical definition. You could also say it's that which solves the double quintessence of wants. It's the most saleable good in a society. It is a market good in many cases, um, and I think that's also a useful addition. The way that I emphasize it in the book is actually initially based on Juventus Casares from years ago, which is that money is a ledger. It's basically but that doesn't necessarily conflict with other things because it's like ledgers are a market good. We kind of part of seeking out good money is seeking out what is like a reasonable ledger that we can use to save value in, to use as unit of account, to price things in, to physically give to each other, or send to each other one way or another, and that obviously changes based on societal technology. And so throughout kind of ancient history, as we got better at mining, we got better at better technologies, we would kind of systematically remove certain types of commodities from being effective as money. Like we'd figure out how to make a lot more shells, a lot more beads, a lot more tobacco, a lot more cocoa. We could kind of like start going up the hardness scale to find the things that even with better technology we could not increase the supply of rapidly, mainly gold and silver, and especially gold. And so we kind of just started crossing off certain things that were no longer effective. And then we've been in like a weird century and a half where we've sped up transaction speeds thanks to the telegraph, the telephone, the radio, the internet, all these different telecommunication technologies. But we still had no way to natively send value to someone. We couldn't do like digital settlement, even though we could do digital transactions. And so we've had this kind of weird hybrid model where first we had to abstract gold so that you can send we're literally banks are updating their ledgers around the world that are ostensibly tied to gold, but not enough people took the gold out frequently enough, and so more and more claims build up on top of the gold. It proliferated a lot more quickly than gold does, and so all those systems broke. And now we've been in this kind of system where it's just a pure ledger that they try to maintain some degree of scarcity for, like the dollar system essentially, and other kind of leading currencies, where it's the first time we've actually taken a step back in hardness in money. So we spent thousands of years kind of going up the hardness list of commodities towards things that are very hard to change the supply of. And this was the first time where speed was relevant. So we actually took a step back in terms of monies that proliferated around the world. And obviously in the past 15 years, now there's the prospect for things like Bitcoin that actually have finally given us digital settlement, that instead of sending an abstraction quickly that has to be reconciled later, we can actually send something that is by its own nature scarce, that's not relying on credit, and just send that to someone over the internet. So we might be entering a new era of money now, but that's kind of been the transition so far.
Mm-hmm. In a way, if you can tie it back to what you just said, is that, as you said, we've built up, went to a digital sphere of nothingness, so to say, because since 71, when Nixon basically cut the peg to gold, it was unredeemable. Fiat money today is unredeemable. It's backed by just pure sheer force, actually. And then since in the modern day and age, we also had the digital sphere, it went from cryptographic technology, all kinds of technology we're going to talk about later on, and went back to, okay, what makes actually money hard? And I think for that it would be maybe interesting to go a bit more into detail to see like what those different phases were. And obviously, like we're not gonna spend too much time on that, but it would be good for the listeners who have not read the book and who I definitely would recommend doing that after this conversation, to maybe outline the major phases in evolution of money, where it basically started, and how throughout time, obviously, like just in a broader sense for the sake of explanation, what always was the problem that got solved with the next iteration of money.
Yeah, good question. I think when we think of the development of money, we can kind of think of two paths that were kind of happening in an overlapping way. So one was the underlying money itself, which until fairly recently was a commodity money. On one hand, as technology changed, as I said before, we would kind of start moving up to scarcer and scarcer types of commodities because other ones would become untenable in a more abundant world. And the other path was basically the path of banking, basically ways to make those commodity monies more divisible, more portable, more secure for transactions. And there is a specific pretty like a technology path there. So it's not just ideas; it's actually certain technologies enabled it to happen, like the invention of paper, the invention of bookbinding, the invention of the printing press. Basically, actual technologies that allowed us to abstract money in a more thorough way. And I kind of chronologue in the book because you start out there's like really old like 2,000-year-old papyrus bills of exchange, for example, but they got more sophisticated over time, and money started kind of having a channel-like like a aspect to it. So, for example, during the medieval times, largely around the Islamic world, kind of basically centered around the Silk Road and those regions, the Mediterranean, you would have a lot of the technology came from that time because that was when Europe had taken a step back in terms of their societal kind of organization, their prowess for a period of time. So the center of innovation was more in that Mediterranean Silk Road region, and they had made advancements in paper that was originally invented by the Chinese, and then they made inventions of banking. So basically, you'd have these types of paper that you could deposit gold with a hawala or a money changer in one city, and have some sort of physical receipt that you could bring or send a messenger to another city that money changer has a connection to, and you could withdraw gold in another city. So you basically are making gold more portable through abstraction. And one way to think of this is it's basically early encryption,
Mm.
because obviously they have to make sure that someone can't just like see one of those notes one time and then go counterfeit them and trick another money changer into giving them gold that another money changer actually didn't authorize, because then they're going to have an argument about who has to pay it. So one will think that another person owes him, and the other person's like, I didn't write that. So they had to have ways to verify that they actually authorized this transfer and that they are now taking on this debt to another money changer as part of this abstraction process. And then with the inventing of the printing press, that was one of the factors, along with just the Renaissance more broadly, that allowed Europe to kind of become the center of monetary development for a period of time. And the printing press allowed for more complex paper arrangements, and things like banknotes, where instead of just a channel based like one city to one city, you could have a large recognized institution that would issue banknotes that are just bare assets that are redeemable for things like gold. And so basically, as the world became more networked together, uh, as information moved quicker, thanks to things like the printing press, or thanks to better ships and just better technology overall, they started to become more interconnected, more complex banking systems. And then, as I argue in the book, that the telegraph kind of put that in overdrive, because that was the first time where humans could send large amounts of information faster than material movement. Prior to
Mm.
then, other than very limited bandwidth ways like fire signals of the night or something, there was very few ways to send money faster than just a person on a ship or a horse actually sending information. So matter and information used to move at the same speed, but when we decoupled those, that gave us a big challenge for money. And so you basically you had to increasingly abstract money in order to keep up in this kind of telecommunication enhanced world. But what that did was it opened up massive arbitrage for the banks and the governments to abuse that arbitrage and that gap between transactions and settlements, and eventually basically take control of it. And so that history of modern banking kind of went from a bimetallic free banking type of arrangement towards increasing levels of central bank with a gold underlay, and then eventually just towards pure fiat banking that is largely based on network effects. So you have 160 different currency bubbles. They all tie together in varying ways into the dollar system. So that's the super currency that all connect into, and that's maintained generally through some degree of institutional separation and some degree of scarcity, which is that we, even though the dollar loses all its value over time, we can always generally be high confident that a year from now a dollar is still something akin to a dollar. And there's a specific set of processes that have to occur in order to create more dollars. Either banks have to lend it into existence, which means they have to manage their credit risk, or you have very large monetized fiscal deficits that rely partially on Congress deciding what they're going to spend on, and then partially on the central bank choosing how they're going to help facilitate that financing. Um, there are certain periods of time, like World War II, where the Treasury just completely takes over the Fed, more or less, and basically says, "This is what you're going to do. This is what you're going to pay for. This is what your yields are going to be." But normally, there's some degree of institutional separation and some degree of sanctity around kind of the speed of money growth itself, and that's been enough to kind of keep the wheels on the cart. So you have something that is less scarce than gold, but faster and more convenient, and still scarce enough that people can use it as money. And like I said, people in, for example, Egypt or Argentina or you name it, they will have literally gray market dollars for people that, they say, well, I do hold some gold, but also I want to have some dollars too. And so you'll see kind of a proliferation in those markets. Um, and that's the world we live in. And I think that we're now increasingly getting the consequences of that system because the system is not inherently stable. It's only been metastable in the sense that it's been able to keep the wheels on the cart for 5 decades and counting. But some of those issues are building up more and more. So the public debts and the inability of so many different currencies to maintain a reasonable ledger. Because if we're in the United States or we're in parts of Europe, we've had a pretty continuous kind of low to moderate inflation for a long period of time, whereas in most people around the world, there it's like if you're 50 years old, you've probably seen one hyperinflation. It's like something that when people think of hyperinflation, they think of Weimar, but the number of currencies that have outright failed in the past, in our lifetimes, let alone like our parents' lifetimes, is immense. Most developing market currencies have either hyperinflated at one point, sometimes multiple times, or they've gone through periods of double digit, triple digit inflation for a prolonged period of time. So it might as well be a hyperinflation. Like they've had to take some zeros off of the currency. It's something that is it's not kept up. Like we still use basically banking transfer technology we used that was invented 50 years ago. Currencies themselves have had such a bad track record. And so we've gotten better at so many other things. We've gotten way better energy abundance. We've gotten way better technology. Like the fact that we're able to do this podcast now is remarkable from different continents. We've gotten better at so many things, and money has, I would argue, been one of the slowest, for lack of a better word, technologies or methods to really keep up with everything else.
Mm-hmm. You could say the same about government in general, about governance in general. I mean, the fact that you've pierced through a lot of things now, which I will try to layer and unpack on some aspects. You were talking about back in the days, medieval Middle East, where they were using Czech. And I love etymologies, and I looked up the etymology of Czech, and it's actually Czech at chess, and then derived onto to gain power over, gain control over. And it's the same Czech and that's like a good segue for what you just said about the outdated, archaic form of money we have today. Correct me if I'm wrong. In the United States of America in 2022 or 2023, sorry, you pay your rent with a check to your landlord. In some parts, I've
In
heard
some
this
in some parts, yes. I'm now a
outrageous.
homeowner. I know. So before I was a renter for a while, and until like the last couple years, it was literally a check, and that was the only thing I used checks for. Um, there was even another case where when I moved in, you had to like pay for like an inspection fee, and they didn't take personal checks. You had to get a money order. So I had to like go to a convenience store, give them cash, and then they would give a, kind of like it's basically a check from a company.
So
So
Western
it's a
Union,
kind of, yeah,
but in
it's
your
basically
own
more.
country.
Yes, in the United States of America, we've been very slow to innovate. Many other central banks have kind of real-time settlement. Until the recent kind of introduction of FedNow, we've not really had that. Um, it just, yeah, we've been very kind of slow moving. And what's interesting is that some countries kind of leapfrog us. So, for example, we were early on the credit card and debit card method of payment. So we build out a lot of those network effects, and everybody uses those for a lot of purchases. Whereas in places like India or other countries, they often, by the time that they got developed enough to have these payment systems, they were already outdated. So they kind of went more directly right to mobile types of payment that in the United States we've been very slow to adopt because we've already had like a decent payment method with the card. And this is kind of how network effects and behaviors can be very slow to change once something gets entrenched.
It's like the unwinding circle. It's just like, for example, infrastructure in Africa. Now they build everything like with, I don't know, like fiber or like straight away from the get go, or like in terms of energy infrastructure and so on and so forth, telco. So my point was more of also like the idea of, and I'm going back a bit in history as well, is the moment of in China. A parallel which I would like to use for today is the flying cash, like the problem that the merchants had back then, just like as you described in the Middle East back then. But denominated certain commodities with certain checks as well by basically exchanging it to each other and by having the risk of not being robbed across the way to cross long distances and so on. And the thing is, the Chinese empire back then, the dynasty, was all of a sudden bothered by the fact that money emerged from those merchants. So it was merchants' private money that emerged from those trades, and they want to have control over it. So they only gave it to only a few merchants, then a few banks, and so on and so forth, until they said, actually, no more. We're going to have full control over this. Started issuing those notes, and what happened next was bank runs. And this is basically the history that we've been seeing on and on. So long story short is that we've been from like basically bottom emergence of money to institutionalizing money over and over. And throughout history, it was little pockets. And now it's basically this global monetary order that's even more complex than before. But what is interesting is to see always this wave from centralization to decentralization and going back and forth to the point where the ping pong is going in a way, and you tell me if you agree with that or your view on that, slower. There's more rigidity where power wants to just grab on that authority of issuing of money and basically backs it through law, which is AKA violence. If you don't do what I say, you go in prison, you do that, you have military, like it's through force. What's your view on that?
Yeah, so I think there's two components of it. So on one hand, if you take out the money side, governments have been using force forever. I mean, go the Roman Empire and every other empire and feudal systems. That's how things have unfortunately been for a long time. But the money aspect in particular, I think that what made it go slower is again the telecommunication age because the gap of the problem being solved is bigger. So basically, the reason these centralization keep happening is that in many cases centralization is efficient, and also kind of power. If you kind of coalesce gold into the banks, if people say, okay, I want the convenience of a bank, so I'm going to put the gold in the bank and then just use that ledger. Well, it's very easy for the government to say, okay, well, these are the 8 banks that have most of the gold, so we with a stroke of a pen, that's our gold now, or we can tell you what to do with that gold, right? So it tends to be centralizing inherently. But in general, if we look at the past 150 years, most kind of challenges with money have been solved with more and more centralization. But of course, that comes at the cost of corruption and the downsides of centralization. Um, Decentralization has a cost to it, but then it gets benefits. And in an era where we want to send money, on the internet to buy something, we want to send it around the world. We want to send it just across all sorts of areas. Um, the abstraction needed compared to commodity money is so big, and so I think governments have had a lot more arbitrage opportunities. We can imagine, for example, what the Platonic ideal of money would be. It'd be something like if we could just mentally beam gold to each other, for example. If that's just something we could always do, it'd be very hard for governments to come in there and be like, no, no, stop doing that. Here's these paper things you're going to trade around and you're going to use that as money. It'd be hard to introduce that. Instead, the way fiat currencies get introduced is basically by initially trying to solve a problem, which is gold's portability, authentication, and other challenges. And then over time, people get rug pulled. And it just keeps happening because on one hand, they're trying to solve a problem, but then the incentives start coalescing and then they ruin it. And then if it gets bad enough, there's some degree of reset, some degree of decentralization again, but then they do it again. And one of the problems we see in developing countries is that it's hard for them to ever, like, separating institutions is very hard. Basically power coalesces and then someone with all the power has to agree to, like, give some of it up. So to make things like an independent judiciary or an independent central bank, it's actually really hard to do.
Hmm.
And so in a lot of countries, it just doesn't happen. And so you have very coalesced government, and the government can just fire the head of the central bank whenever he wants. The president can just get rid of him. And so because of that, you have a very centralized system, which tends to decay more quickly than one that has more degrees of checks and balances in it.
So on one side, the efficiency helps scale it up and basically make it more efficient. But on the other hand, with the risk of a total downfall and a corrosion and, yeah, some to say like destruction of money.
Yeah, if you even look at Federal Reserve settlement practices between banks, the evolution of that over time. So banks used to settle with armored transport of gold and paper banknotes, and then with Morse code, they eventually just said, no, no, like, okay, so all of you put some of your gold and with us as the central bank, and if you want to transfer to another bank, just send us a Morse code signal and we will, we'll in our ledger, we will, move your allocation to that other allocation by writing it down. And it's just like it's a way more efficient way to transfer that. But of course, that's reliant on abstraction, a layer of centralization, and other things like that. And so most of these things, it's usually the reason it happened is with the argument, and in some cases the real usefulness of efficiency. They say, well, this is what we're going to do now. It's going to give us more stability and more efficiency. And then enough time goes by, and then they just rug pull. And it's like they might not even been intending to rug pull in the beginning. It's just how things keep working out
Hmm.
in history.
So I want to come back to what you said first when I asked you the first question about what's your most heretical view on the financial system. And you said money shouldn't be created by any central bank. Why is that?
Because, well, a couple reasons. One is going back to my prior point of how bad the track record is. With 160 currencies in the world, how many would you want to hold? Maybe a handful of them are decent for an intermediate period of time. Most of them are terrible even in an intermediate period of time. And people get trapped in these. They're kind of like fiat matrix. Like they're in a world where it's hard to even know you're kind of in that prison. And basically, what it is, it's an accounting prison and a savings prison, which is that, for example, Egypt's money supply is growing by 24% a year on average. It's been something averaging like 20%. Now it's like 24%, according to economist Steve Hanke. And so imagine you're in an environment and the unit of account you're using is increasing its supply by 20 some percent every year. So now everybody in the society has to find a way to get 20% wage increases every year, or they're getting their share of the ledger diluted. They also have to figure out what they're going to do for their savings. Are they going to go to the gray market and get dollars? Are they going to store it in gold and then pay all the frictions? There's like a spread that you have to do in that environment.
But
or you put it into.
Sorry to interrupt, but the savings account in Egypt right now is around 20%, right? So you would basically still offset that, or not?
Partially, but not everybody has a bank account.
Okay.
So in the United States and in most of Europe and other places, there's very high levels of banking access. But in a lot of developing countries, including Egypt, the overhead cost of a banking account is like not worth it for someone who has a net worth of like $300. And so there's a very cash oriented business, and they're literally holding paper banknotes and getting devalued. And of course, by putting your money in the banking system, you're also getting highly surveilled. That's one of the costs of it. You're getting controlled, you're getting surveilled by doing that. So the exchange is okay. You'll get diluted slower now, but you've given up a lot of your control, and it's only available to kind of the middle class and higher in those regions. And in many cases, interest over the long run does not fully keep up with inflation. And so, if the money supply is growing every year by 20%, those interest rates have not been 20% the whole time. Right now, they're trying to get their grip on inflation, trying to tame it. But there was a period of time where interest rates were like 11% and money supply was still growing by 20%. And they were using things like their reserves like their central bank reserves, their FX reserves, to basically keep the pound, the Egyptian pound, harder than it otherwise would be, based on its supply growth, by selling reserve assets and kind of maintaining a bit of a peg to the dollar. So you can disguise that for a period of time, and then it all kind of comes out at once with these big devaluations. So over like a full, like a 10-year, 20-year period, there's a big chunk of the time where your interest rate is not keeping up with inflation. And then anyone that's in the cash market is not getting any interest rate at all. And so going back to the earlier question of why shouldn't the state issue money, is that one is they're just not good at it. Power corrupts, and having the ability to control everyone's like accounting and savings unit is a rather extreme form of power. But I would say is that when the entire world operates like this, so a lot of people say, I wish we would just go back to another system. But when you see something happening literally everywhere, you have to recognize that the incentives for the system being like that are very strong. That there's not like one country outlier that doesn't do this. And so because of that, I think only with other technologies is that even going to be a possibility, not even a certainty. And that's kind of the challenge going forward, which is that I think people deserve better money. I think that, if money is a market good, is something that should have competition. Like, people should be able to choose what money they use. And in the modern era, if a nation state controls the borders, so they control both the physical borders, so ports of entry, you can only bring so much cash or gold through an airport, for example, or then they control the financial borders in the sense that if your bank wants to wire money internationally, the government has full control over what amounts or where or who can do that. So they have full control over both types of in and out transactions, with obviously some small amount of contraband and things like that can get through. But basically, they have a very tight lock on the borders. And some of the recent technologies start breaking those currency silos. So Bitcoin stablecoins basically say either a decentralized currency or a centralized currency, but in another jurisdiction, like say a gold-backed stablecoin in Switzerland or a dollar-backed stablecoin in the United States or any other country. These are now these centralized hubs that can be sent peer-to-peer. So like you can send it with a QR code over a video call. You can send it over email. You can send it over a DM. And so money can now kind of go around those border checks, and that actually allows money to compete more globally, the way that it used to.
Mm-hmm. So maybe you've answered it partially, but that is then, I would assume, then your answer to what would be a world without central bank looking like with the issuance of money being then de facto private, but private in a public network, and not private in a way that Facebook intended it with the Libra, for example?
I think there's two levels there. So one is that I think fairly quickly, as this technology catches on, it starts with the weakest jurisdictions not being able to maintain a currency anymore, because not only are they competing with things like Bitcoin, but they're also competing with every other currency more than they used to because of that border problem. So now with stable coins, or whether it's gold-backed or dollar-backed stable coins or euro-backed stable coins, most of them are dollars right now. They now have to compete with those, and they have a lot less control over their financial borders than they used to. So kind of like how when a currency starts to fail, people start to dollarize it. The government doesn't really want that to happen, but it just starts to happen. It gets bad enough that people start to just kind of do whatever they can to use other monies. And what this technology does is it vastly reduces the frictions for them doing that. So I think at a much lower threshold, currencies can get crowded out by foreign currencies that are stronger. So I think that's step one. Now, step two is what, if anything, can be done about the biggest currencies. So the dollar, the euro, the yen, currencies like that. As we saw with the Libra, that's very hard to do in a centralized way. To basically say, okay, I know the government has their currency, but we're going to make our own unit that's a mix of multiple currencies. And basically, governments did not think too kindly of that. And so I think that goes back to the Hayek quote, which is that you have to introduce something that's just unstoppable or nearly unstoppable. And so far, the best answer I've seen for that is Bitcoin, because if China has trouble banning something, it's kind of powerful. So China has banned Bitcoin and Bitcoin mining multiple times. It's still the second biggest mining jurisdiction in the world, even though it's less than it used to be. People there still use Bitcoin. It's something that it's powerful. And one example I give is that in 2021, when China did their most aggressive mining ban, it was successful in the sense that half of the Bitcoin network went offline in the course of like a week or two. And if that happened to like any other network, if that happened to Amazon and their servers, and they said, okay, you have to unplug all your servers and move them internationally, or if that happened to Microsoft, you can imagine the disruption in all of their services that would ensue for months, maybe over a year. Whereas Bitcoin, all it did was slow down. So the average block time increased from 10 minutes to 18 minutes. And then the automatic difficulty adjustment kicked in within a week or two, and brought that to 10 minutes again. And then like a swarm that's been disrupted, those mining rigs just kind of gravitated around the world to other jurisdictions. Some of them went to Kazakhstan for a period of time and then went to Russia. Some of them went straight to North America. So Canada and the United States increased their hash rate. Now we're seeing Africa gain a little bit of share with companies like Gridless. And so all they really did was make the network more decentralized. And then ironically, some of that mining emerged again in China. Basically, there's still something like a fifth of the network hashing out of China, even though they tried to ban it. And so that's so far, I would argue, kind of the most powerful alternative to some of the large currencies.
Mm-hmm. So you have already explained quite a lot about that part that actually I wanted to address a bit later on. So that thereby I would like to maybe have a segue into more of the system you've already described perfectly, the run up to pretty much the system we're on today. What are the dynamics, or how did it evolve? And today we are in a system that, if you look about the last thousands of years, I think one of the most consistent things, and it's been regurgitated across the FinTwit space or whatnot, is the long-term debt cycle. And there you go again. It's again about that. But I think it's also one of the most accurate, consistent cycles that we can actually pretty much see across history, and thereby give us an idea about where we are in history in terms of monetary evolution. And one of the things I wanted to ask you was, in that cycle that's been also popularized by Ray Dalio, why first is it important to understand that cycle in the first place, and what are the implications on the current system nowadays?
So I think the reason it's important to keep track of it is because that cycle is associated with monetary change in a big way. And what I described before is that fiat currencies, the big ones at least, are metastable, meaning that they have some degree of stability during their lifetimes, but they are not fully stable. And so small amounts of problems build up and get papered over from recession to recession to recession. But the problem is they don't go back to their prior baseline each time. That'd be a stable system. Instead, it's always a little bit more kind of duct taped and papered over until these things really build. And so one way to visualize it is so for 40 years in the United States, whenever we had a recession, central banks would lower their interest rates, and that would encourage more credit growth to build up, as everything's reliant on credit just always going up. One stat that I gave in the book is that from like the 1960s, which that particular data set, all up to the present day, the total debt in the U.S., so public and private debt combined, increased every single year smoothly and without fail, with one brief exception for 18 months during the global financial crisis. It went down by like 1.5%, and then they basically pulled out all the stops to keep that going up again. And so what happens is that without constant credit growth, the system as it's currently designed starts to fail. So they lower interest rates and they encourage and allow for higher levels of debt loads without having higher levels of interest expense. And that's a cycle that kind of recession after recession after recession keeps happening until they run out of room. They basically hit zero interest rates or even mildly negative interest rates, and debts are extraordinarily high. And then they run into basically a financial crisis that happened in 1929. And it happened in 2008. That's basically when zero is not enough, when zero interest rates are not enough to kind of keep the system going. And so then there's expansion of the monetary base. There's a transfer of private debt to the public realm, basically money printing. But then that last part of the cycle is that if money, it's kind of like the problem keeps getting kicked upstairs, right? So it's like, you start in the private sector, it goes into the real estate sector, goes in the banking sector, and eventually a lot of that excess gets just put into the sovereign level. And then the problem there is that once a sovereign is highly indebted and interest rates are no longer going structurally down because they basically bounced off zero, and if they're ever having any sort of inflation challenge, and if they raise rates, those interest rates are a much less effective tool for controlling inflation because they blow out the fiscal deficit. If you have like 150% debt to GDP and you raise rates to 5%, you're going to vastly increase your fiscal deficit. And then if you're like Japan, the central bank is stuck monetizing it even during periods of above target inflation. And so generally, when systems get to that point, they start getting on track for a reset, or perhaps the less loaded word is recapitalization, where they end up, if it was an emerging market, they would default and restructure on their debt because they would have debts that they can't print, like dollars. But in countries where the liabilities are printable, they basically devalue the currency significantly. And that's been a cycle that's repeated several times. And then with it, usually it's a switch over to another type of money, right? So you go from a gold-backed system, for example, to the Bretton Woods system, and then you go from the Bretton Woods system to just a fiat currency system. And the question is, and this is why it's relevant today, is what's on the other side of this system, right? So as the major powers, and it's not going to happen in 6 weeks, but I mean over the years or decades ahead, as these big countries work through their untenable debt loads, and they no longer have that declining interest rate to offset them, as they either sharply devalue their monies, damage their own monetary network effects, especially in a world where new things exist now. What's money going to look like on the other side of this event horizon? And we don't know yet. I would argue that Bitcoin right now is a strong contender. I also think depending on when that happens, there can be a period of central banks recapitalizing themselves with their gold. So a kind of a sharp currency devaluation that then gets kind of tethered to gold for a period of time to regain kind of stability and confidence in it. But these are kind of uncomfortable situations. I mean, these are something that if you talk about them, you sound like a doomsday person. But really, I mean, these things have happened in like our parents' lifetimes, and in emerging markets, they happen all the time. And if you describe a period of high inflation due to a sovereign debt problem, and people say, no, that's doom talk. And I say, no, that's literally, I, for example, spent the summer in Egypt, and they were having 37% inflation when I was there. And it was terrible, but it wasn't doom. It's like life finds a way. It's not saying that it's the end. It's just saying that there's a transition period, and there's chaos, and there's risk, and there's people get hurt by it, people get helped by it, depending on how well positioned you are for it. And it's just a messy situation that sovereigns go through once they start getting very indebted.
Mm-hmm. And I think there's many components to that. There's also the fact that monetary debasement, and that's what also you mentioned in the book, also comes through a vicious circle that spins exponentially based on what you quoted on the credit theory of Mitchell Innes from 1914 about the debasement due to war, plague, and crop loss, for example, in that case, which obviously exacerbates this cycle that we just described. But it also has lots of social components. And this is also one thing I want to outline is that those monetary changes can also be brutal. They usually result in what you also described in the book with what back then the Babylonians, the Sumerians, had like those clay forms in which they were basically keeping track of debts of mainly farmers. And when there were bad crops, they would basically get their families and themselves slaved into labor or whatnot. But if you repeated that enough, the whole basically farmer population or a big portion of that would be enslaved, and thereby there would be a revolution, and they would go into these temples and administration centers and destroy all those clays and create like a very hardcore, violent reset, and thereby the debt jubilee every 7 years. And we see kind of like the same talk nowadays, but this time we're not having clays. We don't have that kind of system. We have a hyper complex system where ledgers are, as you mentioned in the book, they are spread all across, the dollar being the most dominant one. And it's not something you can just erase or reset. So what would a reset look like today?
I think, well, it's hard because I don't think anyone knows for sure, right? I think that every situation has new aspects to it. Basically, it would look like, I think Luke Groman has used this term, basically like the U.S. with Argentina characteristics, more or less. Like it's kind of like some hybrid between a developed country and a developing country when they go through a currency problem, in the sense that you could get a period of just uncontrolled inflation and polarization in politics because of that. And one of the reasons it's dangerous is that you can get, part like the last monetary reset that happened brought, for example, extremism out of Europe. And in the United States, we had big changes too. They weren't as extreme, but they were big changes of centralization and things like that. When Russia went through theirs, obviously that was a very strong tilt to the other direction that was devastating for the people. And so that's the risk in this situation. Potentially, some of the areas that can benefit are emerging markets that have dollar-denominated debt, because if something does happen to the dollar, their debts get devalued, right? So right now they've been in an environment where, as the dollar hardens relative to their currencies, that can make it harder for them to pay back their debts. But if you go through a big dollar weakening cycle, either a normal one like we saw in the 2000s, or a bigger one due to an actual kind of structural problem, that tends to be when you get booms in emerging markets, because it's kind of like, after years of tightness on them, they finally have a kind of a release valve. But I don't think the U.S. is going to lose its currency situation without a fight. Basically, I think they're gonna hold on to it as strongly as they can, even to their own detriment, the way it's currently structured. And so I think that probably what it looks like is a really weird period of capital controls, stagflation, increasing political polarization, and then it really comes down to where public opinion goes. because eventually people can't put up with it anymore, and they start coalescing in a different direction. And that different direction could be a better direction, or in some cases, it's a worse direction, unfortunately. It could be fascism or communism, basically. Those are like the wrong paths, and the right path is something else, something more stable. And so I think that's the big challenge. And of course, and the way I've been describing it recently with some of these recent military events is that sovereign debt crises basically are likely to lead to war in a similar way that war is likely to lead to sovereign debt crisis. They tend to feed on each other because obviously one of the ways that a country can get in debt is war. But on the other hand, if a country already finds itself in debt and is running into its own kind of inflation problems or financial stability problems, then other countries can perceive that as weakness and say, well, let's see how well they can do war when they're already this indebted. And so then they strike, or they get something that they've been wanting for a while, or they feel is theirs, or X, Y, Z. And so we are seeing, I think, an uptick in just more hostile actions globally. I've been comparing the 2020s to the 1940s for years now, and I've been always saying, like, I'm comparing it in the macro context, like fiscal and monetary cycles to that period. And I would always say I hope it's less kinetic than that other period. We're unfortunately starting to see early signs of increasing kinetic war. And so that's a big variable. I mean, I don't know what the world's going to look like in 5 years. Maybe it stays at a simmer, or maybe something more devastating happens. And it kind of just comes down to what the leaders are going to do. What people are people going to get tribalistic and elect kind of crazy leaders, or are they going to kind of keep their head on straight and try to de-escalate? I think there's multiple things that are happening kind of simultaneously, and it's hard to judge where that goes, admittedly.
Yeah. And actually that part is on page 284 when you do parallels, and I think it's very useful where you compare the 1920s to the 2000 with the booming private credit growth, 1929 and 2008 to the generational financial crisis, 1930s and 2010s as the economic stagnation and rising population, and as you just mentioned, 1940s and to 2020s as a geopolitical conflict and populist deficit-driven inflation. And this kind of brings us to what's happening today. We've seen like ballooning global debt reaching, I think, 33 trillion. Correct me if I'm wrong. Just recently, the total public debt of the United States of $33 trillion. We see some dysfunctioning also in the bond market. We see like weird things happening in terms of just assets across the board. Things that we might, if you're an analyst and you see it, you might say, it's maybe an anomaly of the way it behaves. We see stocks just recently. We just had yesterday a big sell-off in just Google or some tech stocks. The bonds market is also having lots of difficulties, and people that believed in 60-40s portfolio are kind of getting smashed in the last 2 years. So a lot of fundamentals are being kind of revalued, and a lot of those things, I guess, are also tied to what we just talked about. What's your view on like the dysfunctioning and the way for example, now precisely in the bond market, what the underlying problem is that could actually trigger this massive sovereign debt crisis?
Yes, I think we're seeing a transition from a structurally disinflationary period to a more structurally inflationary period, because we had the combination of globalization for the past 30 years. So as China opened up to the world, as Soviet Union fell and opened up to the world, we basically connected Western capital with Eastern labor and resources. And so this was this like multi-decade period of disinflation and efficiencies, and kind of, all the benefits and some downsides that come with that. And so that's been going on for a while, and that's been one of the big variables that allowed interest rates to have their, what some term like a great moderation, basically a structurally declining interest rates and disinflation for a multi-decade period. And the problem is that the system, it's almost like stability leads to instability, because if you have a very stable system that has a unit of account that's gradually debasing, but not too quickly, that allows for the maximal amount of leverage to be built on top of it. Because if you have a currency that's very hard, borrowers are going to be careful to leverage it too much. On the other hand, if you have a currency that's rapidly devaluing, like the Argentina peso, lenders are going to be very reluctant to lend for long periods of time in that currency. And so it's actually that medium state of a gradually debasing unit that historically tends to gather the most leverage on it. And the problem is that eventually, when you run out of the ability to keep lowering your interest rates, and you start actually transitioning to to higher interest rates, that causes a massive shock to the system. And so, for example, the United States has never had 3 negative years in a row for Treasury performance, and we're on track for that happening now. We've had it happen before in real terms. We never have had it happen before in nominal terms, let alone real terms. And that's the collateral that underpins the system. And we even saw last year, UK's government got shaken up by the bond market, basically by the bond market's reaction to some of their budget proposals. And they actually had a personnel shakeup because of the bond market in large part, which is something we haven't seen in a very long time. And so I think what we are is we're increasing evidence that we're going through one of these sovereign debt crises. And that doesn't mean that it all happens next year, for example. Some of these things can take a pause for a period of time. If you get some degree of maybe de-escalation in the military conflicts, or you get a mild recession that helps kind of slow that down for a period of time. But the problem is that those issues are still there. And so when you get past that potential period of, say, brief stability, it's likely to happen again and worse is the problem. And so I think that basically until there's a big structural change or devaluation in some of these major currencies, this is kind of still going to keep bubbling to the surface until it kind of forces that outcome, which can be highly disruptive. And I think that's the path we're on.
Mm-hmm. Some people call for a big deflationary deleveraging. Do you believe that?
I think it's a low probability because we saw that whenever deflation tries to occur, the incentives don't allow it to. So, for example, back during the banking crisis of earlier this year, when some of these banks failed, they could have said, okay, well, anyone with money that's over the FDIC limit, you're going to lose maybe 20% of it, because that was kind of the loss on, say, Silicon Valley Bank. But instead, they said, no, everybody's going to be money good. And we saw the same thing back in the global financial crisis. They expanded the FDIC limits. They bailed out the banking system. And so I think that the people running the system have very little incentive to allow a deflationary deleveraging, especially because that eventually hits the sovereign bond market. Like, what is the main thing that they're not going to let default is their own sovereign bonds. And the problem is that if you start to get a deflationary deleveraging from this high level of debt, that fiscal deficit just completely blows out. And if the central bank is not buying that, then you literally just risk outright default. Like, for example, when UK had their problem last year, the bond market was a vicious cycle. So there was a lot of entities that were holding those bonds on a type of leverage, and as they sold off, they would force other institutions to sell theirs, and that would get even worse and sell even other institutions would have to sell theirs. So it's a cascading problem. And if you didn't have the central bank come in and buy some of them, you literally would risk having a failed sovereign bond auction. And so whenever it gets to that point, even the people in the system that would prefer to be hawkish, they don't blink at protecting their own sovereign bond market. And so I think that basically you can only get realistically a deflationary deleveraging up until it becomes messy enough to threaten the sovereign bond market. If there's not enough demand in the system to buy those large amounts of bond issuance, that's when you get inflation. You get basically central banks doing what Japan is forced to do, which is where even if you're in above target inflation, you're still expanding your balance sheet for lack of better options. And so that's why I think that it most likely trends towards an inflationary deleveraging rather than a deflationary one. Now we still have to watch for signs of a deflationary one. They could do, for example, things like bank bail-ins instead of bailouts. that are more deflationary types of deleveragings. But again, once it's at the point where the sovereign itself does not have much wiggle room in terms of its debt and deficit management, that's when most of the deflationary options are basically off the table in terms of realpolitik, and most of the inflationary ones have a much higher probability of being turned to.
Mm-hmm. And we also seen lately that, I'm not sure if you see it this way, but inflation reaccelerating. And you've also described this in the past that just like, for example, in the 70s, but also in the 1940s, and also before that, we've seen waves of inflation basically going, it never goes up in one straight line. It goes in waves. And is that something you definitely also think is going to be similar or play out differently?
That's my base case, yes, because generally when you have these periods of high inflation, the central bank just doesn't take that without a fight, right? So there's attempts, even in Weimar. We think of like the Weimar hyperinflation, but for example, if you bought gold on leverage, you got liquidated multiple times during that hyperinflation, because there were periods of time where the central bank would really fight back and harden the currency dramatically compared to gold. But then it's like holding a volleyball underwater. They can only do it for so long, and then they let go, and it's a whole nother wave of devaluation. And so what we're seeing now is that the major central banks, except for Japan, are doing their best to slow down money supply growth. In some places, it's even negative year over year. They're trying to slow down private sector bank lending, and it's been a kind of a mixed bag, because on one hand, they are slowing down the private sector. They are slowing down in inflationary pressures. But on the other hand, by increasing the interest expense for the government so significantly, especially in the United States, you encourage more, ironically, fiscal-driven inflation. So it's like they've reduced the bank lending driven inflation. They've slowed down the economy so that we're not over consuming oil and driving the price up, for example. There's various things that they can do to kind of slow down that demand side. But over time, as the sovereign bond market gets less and less stable, eventually they risk going to basically what Bank of England had to do, or what Bank of Japan's always doing, which is having to monetize the debt even when inflation is above target. And I think when they get to that point, we risk having a second wave of inflation. Now, as you pointed out, we already have some degree of acceleration. So there's other things that can cause that, like a firming up of the energy market and other things like that. So we're already kind of seeing stabilization in high levels of inflation, meaning that we're no longer getting kind of like month over month falling inflation. But I think in order to have a big spike, we would either need an energy crisis again, or we would have to see something like the Fed fail to maintain its balance sheet reduction in the face of high inflation, and then have to monetize that in a similar way that they did during the 2019 repo spike, and in a similar way that they did during the whole kind of pandemic era.
Clear. But the one difference with Japan, for example, because in the past we've also talked about the Japanification of developed countries just in general, or the financial system, is that the only difference, obviously the big difference between the US dollar and the yen, is that the Federal Reserve cannot do the same way yield curve control as the Japanese bank does, the central bank. It doesn't have control over the long end of the curve. It can only influence maybe the start of it. How do you see like a play that would kind of try to bypass that, or find new ways? We've seen in the past since 2008 new ways of basically influencing those policies.
So the Federal Reserve did yield curve control in the 1940s for about a decade. And during the heart of the pandemic stimulus response, they actively talked about in their minutes the potential for doing yield curve control again, which they thus far have not turned to. And so the Federal Reserve can go the route of Japan. It would just be a lot more politically challenging to do so, especially as the world reserve currency. Basically, we rely on trying to attract foreign capital to own our bonds. And if you do yield curve control, that's basically off the table. Another big factor is that Japan, they've been in the fortunate position where they've built years of like decades of structural trade surpluses that they've then been able to reinvest in foreign assets. So they've built up a big savings hoard, for lack of a better word. They have a positive net international investment position, meaning that Japan, whether it's the government sector or private sector or both, they collectively own more foreign assets than the foreign sector owns of Japanese assets. And so when they run into the situation, they can do things like sell some of their reserves in order to intervene on their currency from falling too much. Basically, although they have a monetized fiscal deficit, they don't have a kind of structural trade deficit.
Mm.
In addition, most of the Bank of Japan's balance sheet expansion was in the past 10 years. So it was in 2012 that they really started ramping up their QE. And that happened during a commodity bear market. So, you've had, relatively abundant copper, relatively abundant oil for much of that time. And that has helped keep inflationary pressures down for much of that time.
Mm-hmm.
And the problem is that if a country with a negative net international investment position, or a structural trade deficit, or a commodity bull market happening, while the same types of activities are done, they're likely to be a lot more inflationary than what happened in Japan over the past decade. So people often assume that we're going the route of Japan, which would be a kind of disinflationary monetization. But that's really kind of the best case scenario. That's the one where, if you've built up a huge reserve, if you have like the highest level of social cohesion in the world, they can kind of push that more gradually and further than other countries can. But I think other countries are going to run into an inflationary problem a lot sooner than Japan has. And I also think that Japan is going to run into more inflation as they've already been doing, because I think as we enter what I view as a more structural commodity bull market, Japan is very reliant on imports. And so that's likely to contribute to their inflation as well, let alone the rest of the world.
So now, coming back to what you mentioned earlier on, there's also the rise of the contender of such thing like a Bitcoin world, which is basically the counter response of central banks to that is CBDCs. And CBDCs have been obviously criticized over and over, especially for people in the crypto community. How do you see like that threat basically for the financial system or for just users of the financial system in terms of privacy, in terms of control, in terms of financial repression?
So as we go through sovereign debt crises, we already see this in emerging markets. So it's not even theory, it's in practice. So when you look at developed markets in the past, so the 1940s, for example, or when you look at developing countries today, generally when they get sovereign debt crises, they turn to various types of financial repression, capital controls, kind of less financial freedom for their citizens to try to kind of keep people corralled in the ledger that's failing. And so they turn to increasingly levels of draconian kind of controls. And I think that's a big risk that people have to push back against. The good news is I think that because technology today is very different than it was back then, and even different than it was 20 years ago, the combination of social media and Bitcoin and stablecoins and things like that make it much harder to control information and control financial borders in the way that it used to be. And so what I think I think that there's a very real concern around central bank digital currencies, and people should kind of question them or oppose them, basically explain to their elected leaders, if they're at a lucky enough place that they've elected their leaders, to say why they don't support them or why they don't want that ubiquitous level of surveillance and control in a world that increasingly reduces cash, reduces privacy, increasingly centralizes everything. We've had a century and a half or more of more and more financial centralization and surveillance. And central banks are kind of the end stage of that. That's kind of the capstone for maximally centralized and maximally surveilled. And I think that's a world that people should probably try to avoid. And then the other side of the coin is to if you're in the investment space, to build other things that are strong alternatives that can resist pressure. That could be things like, I mentioned before, there are gold-backed stable coins, there are dollar-backed stable coins, there's Bitcoin, but then there's also wallets on top of them that make them easy to use or more private, or just the ways they can go around some of the frictions that could be imposed on those technologies. The easier they are to use and the bigger and more liquid they get, the more people can rely on them to avoid some of these other types of centralizing forces. For example, I would love to see Bitcoins and stable coins and things like that get powerful enough that every Argentinian can use them, rather than just the more tech savvy or just the more kind of resourceful ones. I would like to see that go to every person who's kind of locked in an inflationary environment. I would like to see these technologies be able to reach them in a way that serves what they need to do. And then here in developed countries, as they increasingly go through this, I think the challenge is that they're going to use things like war and propaganda to justify why certain rights have to be taken away. And I think people should look through that, see them for the kind of the transparent propaganda that they are, and not let them turn temporary crises into permanent, kind of financial control and surveillance.
Beautiful. On that note, thanks, Lyn. The future is basically free, and it's only free through technologies like Bitcoin, and maybe, if there's such thing, gold-backed stable coins. So on that note, obviously, if you want to buy this book, this beautiful book of Lyn Alden, you can find it on Amazon and Safehouse, SAIFE, and then house, correct me if I'm wrong, Lyn. You also have the website, lynalden.com, and people can also find you on X, Twitter, on Lyn Alden Contact. Thanks a lot, Lyn. Last question is, what are the top 3 books you would recommend to someone else to read?
So I'm biased, but I'll say Broken Money. I will say Principles of Economics by Saifedean. It's a fairly new economics book, and I think it's a good just kind of foundation for knowing economics. And a third one probably be Lessons of History by Will and Ariel Durant. It's like a 100-page book that just kind of, from their perspective, summarizes practically all of human history. It's kind of like the Cliff Notes version of what has history been, and I find that to be a kind of a useful resource.
Yeah, I think I've seen quite a note pages about that as well.
Yes.
So it rings a bell. Thanks a lot, Lyn. Your knowledge is just like Bitcoin and gold, very precious, and I'm very grateful for it.
Thank you.
Thanks for watching. If you liked this episode, give it a like, and don't forget to subscribe. Leave your actions down below in the comment section. And if you want to watch more videos, feel free to check the most recent video, but also any other video that we've had published on the channel before. See you next time.